The next group, we'll go through them reasonably quickly.
Yeah.
The next group of companies are trading at premiums to their intrinsic value, so they're not cheap at the moment, but they're A1s. Reckon, Thorn Group, GUD Holdings, Fleetwood, Wotif, Monadelphous, all trading at premiums to intrinsic value, but they've got intrinsic value rising anything from 6% to about 17% per annum over the next 3 years. So, keep this in mind. These companies, you need to do further study on them. You can't just go out and buy them. Some of them, as I've pointed out, are expensive, so I wouldn't be buying them. Some of them are A1s, but that doesn't mean they're amazing businesses and they're the best businesses to buy. They're the least chance of having a liquidity event. So they've got the lowest chance of having to raise money and dilute you, the lowest chance of needing to borrow money, the lowest chance of defaulting if they've got any borrowed money.
They really are companies for the risk averse to think about.
Correct.
And this is a point, and I'm sure someone's sitting home listening to this and saying, okay, Roger's doing his best not to over-talk these companies up. But, but you are saying, on your pretty rigorous analysis, they're safe-ish kind of companies.
That's right.
So what about this view? If the stock market is to rise on average, say, 10 or 12% over the next 3 years, on that basis, and that you'll know this analogy, that when the tide rises, all stocks, all boats go up with the tide.
Yes.
These companies probably, not definitely, probably will benefit from those sorts of rising of the tide.
I would expect that A1 businesses as a portfolio, particularly if bought at discounts to intrinsic value, will over time significantly outperform the market. I wouldn't be doing it otherwise. That's certainly been the case in the last 6 months, 8 months, 12 months. When I look back and I look at A1 businesses and how they've gone, those that were at discounts to my method of calculating intrinsic value, they've outperformed significantly.
And the thing is, Roger, talk to the fact that a lot of those companies in there have been mentioned by various experts I've had on the program. These companies could fit the analysis that, well, as the tides go up, I'm still going to stick with these companies? Yeah,
well, you should over time outperform if you just build a portfolio that removes the rubbish. So if you get rid of the companies that are likely to have
your C3s,
the C5s, you remove the C5s, you're likely to avoid the situation where your portfolio, your performance is going to be dragged back. But yes, these companies are listed, so people have talked about them before. The difference is that I'm cutting through, I'm taking all of that, and saying, okay, well, you've mentioned 5 stocks and you've mentioned 10 companies and you've mentioned 3. Well, I like that one, but not the other 2. I don't like 9 of those, but I'll take 1 of those. And 2, you've mentioned 2 that I actually like. And I'm building a very, very different portfolio to the 3 that were suggested. So yes, they've been mentioned before, but by combining them because they've got commonality or characteristics that are similar, I'm able to refine that portfolio.
Okay, this might be difficult just on live TV, but I want you to try and achieve it. Of that list, what are the companies that are trading at a discount to their intrinsic value? So these are the companies that people, I think, would really love to write down from the show tonight.
Sure. And again, I'm not predicting their share price. I'm valuing a company.
Just using your criteria, these ones that look like good value on your criteria. But
valuing a company is different to predicting where its price is going to go.
Sure.
But keep that in mind. Okay,
it's a very important point. We'll finish up on
descending order. So the cheapest, they're all at discounts. These that I'm about to mention are all at discounts. But the biggest discount first, the smallest discount
It's a good little
last.
computer you got there, you can do that.
Okay, Matrix, Composite and Engineering, Nick Scali, JB Hi-Fi, Oriton, ARB, Centrebet, DWS.
Okay, fine.
I have that as a table, so we'll put that on my blog and we'll put that on your website.
People can watch this video on my site tomorrow.
We'll come back in New Year, we'll have a look at how the stock market's gone, the index, while we've been away, and then we'll have a look at how that little group of companies has performed as well.
Yeah, without a doubt. Because I think a lot of people would like to think that they're committing their money to a safe group of companies.
Sure.
And your A1s fit the bill there, your A1s, A2s. But it's also nice to have a little bit of exposure to companies that currently are trading at a discount.
Sure.
And therefore...
Well, that's the whole modus operandi of mine,
Okay. I guess, is there any other warning you'd like to make about the fact that these companies, while they look like good value in terms of buying today, it's no predictor of what they might do in the future?
Well, the only caveat is that you want to make sure their intrinsic value continues to rise. So I'm looking at the intrinsic value expectations for the next few years. The lowest is ARB with 3.5% or thereabouts, and the best would be DWS and Oriton, which are expected to rise by about 13%.
Yeah.
And that's not their share price, their intrinsic values. So if that changed, if these companies come out with an announcement to say, we believe now that our profits aren't going to rise or our profits are going to fall, that's going to change the forecast intrinsic value, and that'll drop. And all bets are off. Then you've got to be monitoring this stuff quite regularly.
Have you ever run any tests counterintuitively on the predicted intrinsic value and the share price response? Or this work is not old enough to give you that kind of...
One, it's not old enough to really give you something that's statistically significant, but I do know that since the 1940s, Benjamin Graham's been saying, in the short run, market's a voting machine, in the long run, it's a weighing machine. So in other words, in the long run, price is going to follow the performance of a business. So if I look at the intrinsic value of Qantas over the last decade, it's unchanged. The intrinsic value of Qantas today is the same as what it was 10 years ago. Share price is lower than where it was 10 years ago. Telstra, its intrinsic value has done nothing for 10 years. Its share price is lower than where it was 10 years ago.
Now give us an alternative of a company where the intrinsic value has risen and its share price has kept going
Woolworths has gone up. Its intrinsic value has risen from $2.50 or thereabouts 10 years ago to $26 today. Its share price has done a similar thing.
So what you're saying is that there is reasonable history, which is not necessarily a reliable guide for the but there's reasonable history that companies that have a really good intrinsic value and the share price is less,
and they're an A1, a good quality business,
there's a good chance that because of that they will head up.
Nothing's certain in life, but look, that's what Buffett's been doing for 40 years. It seems to have worked for him.
Okay. Are there any other warnings you want to make for people listening to what we've talked about tonight? There's some great companies we mentioned. Are there any other warnings you'd like to make in terms of them constructing their portfolios? Just
make sure you don't bet the farm on any one company, and that's why you need personal professional advice, because you've got to make sure that you're doing the right thing for you, and everybody has different risk tolerances. So I might be happy putting 7% or 10% of my portfolio into one company, but for other people, if they lost 5%, if a share price halved and they lost 5%, that could be the end of the world for them. So it's very important to go and get personal professional advice.
I think we've talked about this before, but I've often said that I like a portfolio that has 20 stocks in it because it only gives you 5% exposure to any one stock.
That's if you weight equally.
But of course you then have to change it regularly as share price.
Well, then the share price appreciates, and it becomes a much larger portion of the portfolio.
That's right, and that's why some people need help from an expert. Other people can actually do it themselves. But you actually like less stocks, and talk to that.
Okay, I like to. I guess I'm what's called a high conviction manager, so I prefer to place larger bets on the things that I feel most confident about, and I don't see the sense in buying your 10th best thing when your first best thing is cheap. So buy more of that.
And the reason why I said that is that but you have an ability to identify the companies you have strong conviction for.
Sure.
Most people don't, and because they're a bit like punters, that's why I often say, well, if you are going to take a group of stocks, at least spread the risk, and unless you've got better criteria for selection.
Even the world's third richest man, Warren Buffett, said the same thing. If you're a know-nothing investor, he doesn't mean to be disparaging or derogatory. What he's saying is, if you're not in the business of analysing companies, if you don't want to work out which are the best businesses, which have competitive advantages, what their return on equity is, all that sort of thing, if you don't want to do that, then really you need to be in an index fund. You need to take the broadest possible approach.
Great answer, Roger. Great seeing you, mate.
Thanks.
Thanks for joining us on the program this year.
Happy Christmas.
Yeah, and same to you. And I can't take you to New York, but we'll miss you.
No, that's fine.
And we'll see you in February.
Okay, cheers.